Now I don't have to remember to edit it all when we're done.
At least we're recording. There you go.
All right, everybody. So, for those of you who have been or are new to the weekly webinar series that we've been trying to add value by talking about different subjects every Thursday in the group at 4. And we've done presentations on house hacking, time management, creative financing, a couple different creative financing presentations. Steve Sims came and talked to the group about, that was just fun about achieving crazy goals. And today we have Zach Lemaster, who is the founder of Rent to Retirement, which is a really big and successful turnkey real estate company. And he is a Air Force veteran. He is a optometrist by former profession, I guess. Technically still an optometrist, but he does houses now. So much more successful in that. I'm sure he was quite successful as an optometrist, but that's just not as much fun to talk about on a webinar as the amount of crazy things that they do with houses. So I'm going to let him deep dive into turnkey and what that means, but it is a strategy that makes sense for I think service members in a lot of different scenarios, especially when you're like, man, I'm stuck overseas and I don't know how to buy real estate, or I'm out of state, or I don't have time for this because I'm in a constantly training or deploying environment, or there's just a lot of situations where turnkey can be a really good option. And Zach and his team crush it. They have a lot of really good systems in place that I think set them apart from I don't want to say that there are a lot of bad apples in the turnkey business, but there are some, well, in every business. And so Zach and his team have some pretty cool ideas behind the way that they run business that I like, and was one of the reasons that I just enjoyed talking to him whenever we first got to meet, and when we did a podcast with him recently. And I'm excited to bring him to the group to talk about turnkey real estate, what that strategy looks like, his business, the success they've had. They do a ton of transactions across the country, and to be able to answer some of your questions. So, Zach, thanks for joining us today, buddy. And I'm going to just kind of shut my camera off and leave the floor open to you.
Man, what an intro, David. I appreciate that. And by the way, while you're still on here, can we, since this is live on Facebook and potentially, I think, other areas, but I can't actually see the questions. I know we want to do a live Q&A, but I cannot see the Facebook questions on here, right? On the Zoom.
No, I can read them to you, or I can drop them in the chat from the Facebook group.
Sure. Yeah, either or. So for anyone listening, we'd love to, I want this to be interactive. I think that's where the best value is provided. And so if you have questions about out of state investing in general, or turnkey investing, I mean, that's what we're going to talk about today, or any of the stuff that we go through. We're going to mention some stuff about build to rent. But yeah, feel free to drop your questions in the chat, and then either David will run through them or put them in the Zoom chat here so we can address them. I do have a prepared presentation for you, maybe about 20 slides. We'll spend probably 20, 30 minutes going through that. And then of course, please plug in your questions throughout the presentation, and then we'll do a live kind of open-ended Q&A at the end. So let me go ahead and share my screen here. And I will go ahead and just kind of present on who we are, who I am, and what the hell is turnkey, and why should you potentially consider it? Who is turnkey right for? Because it is one of these buzzwords that we hear all the time. It's really ill-defined. So I guess I'll just initially start by just giving just a broad overview of I'll go more granular throughout the presentation, but what is turnkey? Turnkey generally means, or what it is to us at Rent to Retirement, is basically where investors, we're making it easily accessible for them to invest and diversify in different markets throughout the country without having to do all the heavy lifting of building your own team from the ground up, finding contractors and management, trying to find deals and negotiate those, rehab houses. This is an area where we've already set up the business model for you. These are long-term buy and hold properties that you're going to add into your long-term strategy to allow you to diversify across multiple different areas. And we're very strategic and intentional on where we want to invest. So let's just go ahead and get started here. I appreciate, David, the excellent introduction from you. Just to kind of review a little bit about myself. So As David mentioned, I'm a Air Force vet, so I know we probably have a lot of Marines on here. We'll save the military banter, but basically, I started my career path as a captain in the Air Force. I was a commissioned officer because I was on scholarship for optometry school. That's where I met my wife. She's also an optometrist. After I graduated optometry school, I spent 7 years in the Air Force, making sure everyone can see appropriately in whatever their career path is. And I really enjoyed that. I really enjoyed optometry. It was great. But we've been investing in real estate, ever since that first year I joined the Air Force active duty. And that was a house hack. I bought a duplex, lived in half, rented out the other half. And I never looked back. Every single year since that year, which has been about 15 years, we've bought more and more real estate every single year and strategically started to invest out of state. And that's really where our business has taken off. So I invest in single family, multifamily, commercial. We have a lot of new development projects across the country. We're very intentional on where we choose to invest for a handful of reasons, which we'll go through. With our company, Rent to Retirement, we've done over 3,000 transactions over the past 10 years, equaling over 500 million real estate assets, transaction-wise. And personally, we've achieved over 7-figure annual passive income from our rental portfolio. And that took us less than 8 years to do that. And I say that not to brag, but to showcase that, looking back when I was, young captain in the Air Force or starting to invest in real estate, I never thought in my wildest dreams that we would be to the point where we are investing. But we did get here. It didn't happen overnight. And it's quite possible for anyone investing in real estate. Like if you just stay the course, and there's always obstacles, roll with the punches, but if you just stay the course and can you continue to learn and apply what you learn and continually invest, like actually take action year after year, you will have dramatic growth, exponential growth to achieve what you want to achieve. And it's interesting to see how your goals change over time. All right, so let's talk a little bit about like what Turnkey is and why it's important to invest, out of state. I think the big benefit to Turnkey is investing in, the ability to easily diversify. A lot of us start investing, which is completely fine, in our own backyard because that's what we're comfortable with and that's what we know. The reality is, more than likely, your own backyard is not the most strategic market for you to invest, or maybe not where you can get the highest return on your investment. And so it would be advantageous for you to be open to investing in a different area. And actually, I think we have an advantage as military members because we're moving around all the time, right? If you're active duty, you're only in one spot for a few years anyways. So it's like you're almost forced to be open to the idea of owning a property that in an area where you don't live and building a team in that area. Or if you're overseas or deployed and you're continuing to invest, you're relying 100% on a local team. But from our standpoint, being strategic about and intentional on the areas that we wanted to invest instead of just investing in our own backyard. Like once we opened our eyes to investing across different locations where we got simply better returns, that is really the catalyst that has allowed us to grow and scale our portfolio dramatically over time. And so I think it's important for people to be open-minded to that and conscious of that about investing in different locations, especially if your local market is too expensive, or if it's just not the most advantageous place for you to invest. The challenge is, how do you get started investing, right? How do you build a team from the ground up? You can certainly do it on your own, but that does take a lot of time and energy and money and risk. And so I think that's kind of where if you go the turnkey route, it does provide at least an option for you to tap into an immediate team that's already established in these areas. So diversification is also key. Let's just talk like fundamentally, and I know this is probably rudimentary and redundant for a lot of people, but so just bear with me though. Let's just talk about like investing in residential real estate specifically, because that's really what our core business does at Rent to Retirement. We focus on houses that are newly built or fully renovated, leased, and professionally managed in areas that we've identified to be a positive investment market, mainly in the Midwest and Southeast. And we'll talk about more market metrics as we go through this. But like, why residential? Because there's all different ways that you can invest in real estate, passively, actively. There's all sorts of different asset classes. You have commercial, all sorts of different commercial assets. We have, built to rent, we have multifamily. Residential real estate is, I think, the most predictable way to build passive income and a strong financial future, because it's a human need, right? Housing is a necessity. And that's not going away. And in today's market, we actually have an under supply of housing in a lot of areas that we're investing in intentionally, because that's where you have demand for resale and for rentals. That's where you have strong rental growth year after year. And so these are certainly areas that we want to be in the path of progress where there's a demand for housing. But residential real estate, people always need a place to live, right? And this is just a really predictable path to financial independence. And so that's like we like residential. It's one of the oldest forms of investing because it's a human necessity. We know that with residential, especially single family and small multifamily, meaning 2 to 4 units, these are very accessible for most people because of financing is so readily available to them. We especially like single family and the small multifamily because they tend to appreciate better than many other asset classes. They tend to be more liquid. You can sell them a lot of times to an investor or to a residential buyer, especially single family. And so, it allows you to exit those. They're not as dependent on the market when you have both residential or, owner occupied or investor exits on them. And so there's just a lot of reasons that investing in residential real estate is, I think it's an easy entry point, low barrier of entry, it's scalable, and it's very predictable over time if you invest in the right locations. A lot of us, ourselves included, actually at this point in time, the majority of what we own is commercial retail and some industrial. But I think actually more so, we're heavily invested more in like the business sector than we are in the residential. But we started in residential and we continue to grow our portfolio quickly in residential and trade up our portfolio through 1031 exchanges. And I think that's a really just predictable path for people to follow in residential real estate. So kind of talk about this a little bit, but just to reiterate, so when we talk about turnkey, because it is one of these buzzwords, really what rent retirement is referring to is a house that has been newly built or fully renovated, leased, and professionally managed in a market that we've identified to be a successful investment market. Now, when we talk about what market is a successful investment market, these are areas that have landlord-friendly legislation, low taxes, future population and economic growth. They have a diversity of industry. They're not just reliant on, say, oil or gas or one industry, which could be volatile potentially in the marketplace. And so it's extremely important that we are being intentional on where we are investing, because this is a lifelong journey. Our goal is to build a sustainable portfolio that's diversified across some of the best locations throughout the US, where we can get positive cash flow because the rental numbers are high relative to the home prices, and we can keep the house rented because there is rental demand. We have rental growth year after year, but we also have strong appreciation. The benefit to investing in turnkey, at least with like our company, the value that we bring to our investors is not just buying a house that's got a higher propensity for success long term than potentially doing it on your own, but it's the ease of access to diversification across these different markets and a team. Our goal at Rent to Retirement is to allow people to build a successful business model long term investing in real estate, regardless of what else you're doing with your own investing career. So, when you're investing in real estate, you're building a business, and you need to approach it the right way, right? You need the right tax and legal structure in place. You need to have the most appropriate financing set up based on, what your personal goals are. There's all sorts of different financing options. If people are using a self-directed IRA to invest with a non-recourse loan, or, maybe if you've maxed out your 10 conventional loans. So our goal is to offer a comprehensive approach and try to help people to plan for the future, not just invest in a property that they can receive passive income from, but really approach this like a business. And so really the question is like, when do you know if turnkey is a right fit for you? And what we found is that turnkey can fulfill a variety of different needs for investors, depending on what your goals, your background is, and ultimately what you want to accomplish in real estate. We have many investors that, hey, this is an easy path for them to buy their first house because they're just, they need a little bit of comfort walking through the process, hand holding, or their first investment out of state because they don't know where to start and they don't want to take the time to build their own team from the ground up. But we also have professional active investors that are full-time investors that also buy turnkey because it's an easy way for them to diversify and scale beyond what they're already doing. For example, we have one of the largest trade of finance investors that invest with us every single year because he's just buying it for tax purposes. He does accelerated depreciation on them, on some new construction that we built for him in Florida. He knows that he doesn't have to think about these. He can just buy them, but it's a tax play for him. Because he needs to buy more and more real estate every single year to offset his active income through his coaching, through his deal flips and things like that. But generally speaking, Turnkey is a great way for people to easily get started, to diversify, or to scale in addition to whatever else you're doing in rental real estate. And scalability is really the name of the game here. If you're trying to achieve any sort of financial independence over time, it requires a large portfolio, right? So you want to be creative about how you can grow your portfolio strategically and continually add doors, but also do that strategically and diversify across multiple markets. No one wants to be invested, or should be invested, in my opinion, in the same, all of their eggs in one basket in one market. And as I mentioned before, markets are dynamic, and it's really important to be conscious of where the best opportunity is. There's some areas, even right now, today, where we're still seeing 20% year after year appreciation in both market value and rents. And so you don't have to come in and try to buy an undervalued property, right? You just need to buy a property in the right location, which after 15 years of being a professional investor, I can tell you that it's true. Like, right, the location, that is a true thing, where if you just simply be strategic about where you invest, that's what's really going to ultimately determine how successful you're going to be over time, not necessarily buying a property way below market value. Sure, you get those home runs occasionally, but if you consistently invest in the right locations, that's really what's going to allow you to excel your portfolio. And that's, we try to be strategic with our business and our own investing of where we want to invest. So, but we have a lot of investors that, they're active duty military. They're obviously busy, they're being deployed, or they're all over the world, whatever the case is. And this is an easy way for them to continually tap into investing in the US in some of the best locations, or people that are, they're busy professionals. We have a lot of people that are, W-2 employees or run their own business, and they don't necessarily want to be an active investor. And this is an easy way for them to, grow and scale their portfolio. So I'll try to, I'm taking some tangents here, so I'm going to try to speed up here a little bit, because I can easily turn this into a 3-hour presentation. And I know that David made it very clear to me that he wants it to be about an hour or so, and I want to save some time for Q&A at the end. So I'm going to try to breeze through some of these other slides here, but our mission is to assist real estate investors in building a sustainable and diversified portfolio with established teams in the best markets in the US. I think we covered that. We do offer single family, multifamily, commercial, and new build properties in different markets. I'm excited to talk about some of the new construction stuff, because that is an area that's in particular is very exciting to me, because you can basically come into a house with immediate equity that you can do a cash out refinance or sell to gain within, a few months of the house being completed. And that's really interesting, because that allows you to be a strategic investor. So we're going to go through that a little bit more. So we talked about markets already previously. We want to make sure that they're in the path of progress, have high rental demand, landlord-friendly legislation, low taxes. These are all things that are important for building a sustainable portfolio long-term. And of course, we want them to be positive cash flow, but it's all balancing where we can maximize the best benefits of cash flow, appreciation, and equity. And it is quite possible to come into properties with all three of those at once. So really, building a sustainable business model is really important. As I mentioned, we get a lot of questions. And if you have questions about setting up LLCs or investing out of state in general with how taxes work or anything, like, put those in the box or in the question comments, because I'm happy to address those. Just in general, investing out of state, that is our core business. But again, at Rent to Retirement, we try to bring a comprehensive approach to assisting people in building a business long-term. You need to have the right people in place. You need to have your kind of, like, as Robert Kiyosaki would say, your advisors, right? His rich dad advisors. He had his real estate specific accountant and an attorney, and all these people, and property managers, like all these people he has put in place specifically to be successful over time. And often we found a lot of people, like, sure, if you're doing your own taxes, or if you have a CPA that's not familiar with real estate or not familiar in investing, in multiple different states, maybe that's not the best person to have on your team long-term. But these are all resources we're happy to share with you, whether you invest with us or not. So really, that's how the process works, at least with my team at Rent to Retirement. If you're interested to invest out of state or in a turnkey property, the first thing we want to do is have an initial consultation with you with one of our investment strategists. This is where we go through your investment goals, criteria, timeline, resources. We do some market analysis. And I'll say this too, everyone, we put out a lot of educational content. We have a great podcast. As David mentioned, he's been on ours. We've been on his podcast, sharing stories. We have a lot of excellent guests and resources talking about all things real estate. We got a lot of education on our website and blogs and free tools for you to use. We're passionate about real estate. We love investing in real estate. That's why we still do this business and operate this business, is because real estate is a lifelong journey. So, I mean, we're here to add value and assist you in looking at markets, learning how to invest out of state, regardless if you invest with us or not. We don't charge investors anything to participate in our community and be a part of our program. We're here just to offer value and provide educational resources. We make our money through the building and the rehab and the sale of these properties. So if you do buy a property with us, fantastic. We'll continue to help support you long term. But I just want to make you aware of that. Like, we don't charge anything to people. So feel free to reach out, right? And like, if you just want to pick our brain about different markets, please do that. So after you have a initial investment strategy with one of our investment advisors, they're basically going to, look at your financial scenario, give you an advice on, maybe what markets you should invest on, maybe give you some homework. But basically from there, you have some homework steps, and usually that's finding the right lender to work with. There's all sorts of different lenders available, and having a lender that is, probably licensed across all the states that you want to invest in. There probably should be an investor themselves and know real estate, and also competitive in their rates and fees is extremely important. So we have a ton of lender resources for you. But usually you get a pre-approval, and then you come back to the team and say, okay, I'm pre-approved. We've had our initial discussion. Let's build out an actual strategic plan where we start to dive deeper into different markets and properties, and then going through the identification process of trying to determine where to invest. Once you find a property that you like, put under contract, go through a normal closing, have all normal due diligence, appraisals, inspection, get set up with management, and then make sure you have the right legal entity structure in place. You have the right accountant. And then we focus on, okay, how do you scale? How do you rinse and repeat? Again, scalability is the name of the game here. Let's go through a couple property examples. I think this is, most people are like, okay, all this you've been saying is great, but like, tell me about the numbers, right? Tell me about the locations. So we invest mainly in the Midwest and Southeast. Our main markets right now, Midwest would be Kansas City, Missouri, areas around Cleveland in Ohio. Often we've been very successful in what we would call secondary markets. These are areas that are, say, within a 30 to 60 minute commute to a large metropolitan area. And the reason we like these areas is because, they're less expensive. Usually they're a fraction of the cost of a large metropolitan area, but they still have growing demand, especially as these areas continue to grow. People are, moving out to areas where they can still commute to, say, downtown, but they're growing their families, and they like the lower cost of living. A perfect example of this would be one of our best markets is right outside of Orlando in Florida. We work in Polk County, which is Poinciana and Haines, some of the cities in this area where we're doing new construction, where the same house is like 20% of what it would cost in Orlando. In Poinciana, however, the rental rates are not that far off, right? And so from an investment perspective, you have way better cash flow there, where you would not be able to be positive cash flow at all in Orlando unless you're putting like 50% down. And this is an area that is constantly growing. So just being aware of those types of things are really important. So anyways, Ohio, Missouri, Indiana, this property here is in Indiana that we were talking about. Those are our main Midwestern markets. We still have a little bit of stuff in Michigan and in Iowa, but Kansas City, Ohio, and Indiana are our main Midwestern markets. In the Southeast, we're very active in Texas, Alabama, and Florida being probably our best market, and that's usually main new construction. But this is a typical example of a turnkey property. This is one that I think it's outdated at this point. It sold last year, but this is a B-class house for $134,000. A lot of people, depending on where you live, may say $134,000 is a down payment on a house where we live, or it's like that must be in a terrible location. This is not. You can kind of see the look. This is a general B-class area. This is, when you talk about a B-class area, you're probably talking blue collar type of individuals. This is where you have the highest rental demand and largest tenant pool. And this is an area where you can still cash flow well. So we kind of like to be in that lower A to middle B class type of location. And this is renting out for $1,100 a month, at least in 17 days for marketing. That's usually average, I would say three weeks on average from time of listing to leasing. It's just a bread and butter rental house that's going to produce a 15% cash on cash return. I'm assuming the numbers on this, we're using a conventional loan with 20 to 25% down. Actually, it looks like 20% down on $27,000. So this would be kind of a standard deal. Typical deals we were looking at in the Midwest, $150,000 to $250,000 for a B-class single family, or maybe a duplex that might be at that 10 to 15% cash on cash return. You can see the rehab that goes into this. A lot of questions I'm sure you'll have over time is like, okay, if you're rehabbing a property, what type of rehab are you doing? Do you have standards of care on these certain things? Absolutely. When you're buying a property that's rehabbed, you get a full scope of work to show you exactly what was done. All the major systems like roof, HVAC, electrical, plumbing, all those are replaced if they don't have significant life in them, or if they weren't replaced like past 3 years. And so the goal is that you're coming into a property that you're not having to make a lot of repairs on shortly after closing on it. I want to transition here, and we're almost done, guys, so bear with me. I'd love to get to some of your questions. I want to talk about the build to rent stuff, because build to rent is a unique place, and a lot of people like separate this out from turnkey. Again, turnkey is a broad spectrum of basically buying a property that everything's done for you, and that can have multiple different asset classes. A lot of the commercial retail stuff we buy, no one calls it turnkey, but it certainly is turnkey because it's fully leased. And taken care of. We have our property management team take care of it. But we also personally have been very successful in the build to rent space because there's a lot of opportunity where basically you can create equity and come into property below market value. And I'll go through a very specific example. I think we actually have one of these points on a house in Polk County that I mentioned. But build to rent, generally what I like about build to rent is that these are houses that they're brand new, right? They're new construction. Everything is brand new in the house, because even on the 1950s house that's fully rehabbed, there still will be more maintenance on that house. There just is. With a build to rent house, you have like 10-year structural, and long-term mechanical warranties on these things. There literally should be zero maintenance on them at all the first year, and very little maintenance over time. That helps to allow predictable cash flow. You usually get better quality tenants, and they're in areas that are in the path of progress. That's why people are building in these locations, is because there's a huge demand for housing. And so that's why we're building a lot in the Southeast, because that is where the population is growing dramatically, in areas like Texas, Florida, and Alabama. And so this is a great area that you can come into a brand new built house with little maintenance, have a usually better quality tenant that stays longer, that tends to, renew their lease and have higher rental increases year after year. But you can also come into an option where you have immediate equity to allow you to either do a cash out refi quicker than you normally would, to recycle your money, or sell that property at a gain. The downside is new construction. It's more expensive generally. So you're looking at, $300,000 to $400,000 as the average purchase price for most of the single family or duplexes that are being built. The cash flow would probably be, the cash on cash return is going to be a little bit less year one, but we anticipate that to pick up year after year as you have your rental increases. And you might have to be a little bit patient. If a lot of times, like for instance, what we'll do is we'll bring houses to the market that are like 90 to 120 days before they're completed, to allow you to reserve those. And then of course, when the house is completed, you put a deposit down and reserve it. When the house is completed, you can go through and purchase it. And then that allows you to, so it's a little bit of a delay period, whereas like a turnkey rental in the Midwest would be finished, rehabbed, and leased. So, and some of these, sometimes we've gotten away. I know I have on here 12 to 18 months build time. That's total build time, but we're not even bringing them to the market till they're, probably 3 to 4 months out. And we do have new construction in a few different locations. So let's go through an example. So yes, this is an exact model of a house that is in Poinciana in Polk County, right outside of Orlando, which I was referring to. So this is the house that, we're basically through our network. All these are off-market deals, by the way. We don't sell any residential end users. You're not going to find any of these on the MLS. We sell or work with exclusively to our community of investors. So That's important. That's part of what the community, our community, the value that they get is having access to our deal flow. But this is a brand new build house, 4.2. That's around 2,000 square foot, rents out at $2,350 a month. And we sold this property, or we're selling these for $312. I think prices are actually going up a little bit over the next couple of months, but essentially these houses are appraising for $350,000 to $360,000, which means you have a significant amount of equity in here, right? You can turn around and sell this once it's completed. You can sell it on the retail market for $350,000 to $360,000. Now with realtor fees and things like that and taxes, like it may not make sense to do that day one. You would still come out positive more than likely. But you have this starting equity point where, yeah, maybe in a couple of years, you've expedited the equity position. You can sell it sooner for a gain, or you can do a cash out refinance to take some of that money out and reinvest it. It's just, coming into immediate equity is an interesting scenario where, maybe over the past few years, this hasn't been as accessible because of how hot the market is that now actually there are. And we do have, this is just one other side note. I know we're covering a lot. I'm going through kind of the rapid fire stuff. We actually have some lenders on these some Florida stuff, and especially the Alabama, new construction only, where they will do 100% financing on it. Now, those properties, understand, those will be negative cash flow, as most things will when you have 100% leverage on a house. But it's a really unique scenario for someone like, if you just want to control more real estate and own the real estate, your return on investment, and this may be a strange concept to people, but your return on investment overall, when you factor in the tax benefits, just normal depreciation, not accelerated depreciation, the debt reduction, the appreciation in, immediate equity that you're coming into on some of these houses. If you have a negatively cash flowing asset at 100% financing, your return on investment is actually still positive. Well, technically it's infinite if you have zero money down on an investment, but that's a really unique opportunity for people to grow their portfolio and control more real estate. If they're in a financial position to understand they're going to have a property that's, maybe it's a few $100 negative cash flow immediately, if they're using 100% financing. I normally tell people don't ever buy a property that's negatively cash flowing, but clearly when you have 100% financing, it's a different play, right? Like we buy a lot of these for tax purposes, so we can run cost segregation and accelerated depreciation on them. But I don't need the cash flow. We need the tax benefits. And we understand that we're getting a positive return on our investment just from controlling more real estate. So I'll just say that without like going too deep down that rabbit hole, unless people want to know more about that product. Those are some of the creative options we make available to our investors. And this is not, by the way, this is not a loan product that you can just go and get somewhere. This is specifically a loan product that we've spent many months creating with a local credit union that has been made this accessible only to our investor clients because of, the relationship we've built with them. So just something unique that we can look at with people. So back to this property, brand new build house. I mean, this is just a beautiful house in a great location. You can see the interior of it. This house is staged. These don't come with furniture. Some people do use these as short-term rentals, but obviously you would need to furnish the house. And there's a little bit more, you need to be a little bit more strategic in the exact location that you're working in. So we do have some short-term options available, like on the Gulf Coast in Orange Beach, in Alabama. We have a turnkey investment product that's a short-term rental that's higher price points. Usually you want to be in better locations. You got to furnish houses. So it's like higher price points, but those are options. The majority of what we operate is in the long-term rental space. And I just want to leave this with everyone. This is my last slide. But I just want to mention that real estate, I mean, we use the acronym, it's the ideal investment. And this is, I don't know who we got this from. I mean, this is not something we came up with, it's all over, but it's just a good reminder of really real estate. And this goes back to me personally, what has allowed us to be very successful over time and reach our goals and then exceed them and then dramatically exceed them and create like generational wealth for our family is just simply owning rental real estate and just doing that, I'll say this, being strategic about where we invest and continually investing year after year is what has allowed us to be successful. as investors. And if you just stay the course, you get started, you don't get analysis paralysis, you get started, you be intentional on where where you're investing, what strategy you're working on, and you just keep doing that over time, you will certainly be successful in investing in real estate. You'll get some bumps and bruises along the way, and you'll have some obstacles, but it's very important to invest and just stay the course and learn and apply what you learn to be a more successful investor. But we use this acronym because it is a reminder of why real estate is the best asset class out there, right? Because there's nothing else that compares. There's a reason why more millionaires are made in rental real estate investing than any other asset class, and why millionaires are created every single day through real estate. And that's because of, being creative and growing your portfolio in all the ways that you grow your net worth. So this is the acronym, I is income, which means cash flow. As a newer investor, sometimes we focus a lot on what is the cash flow on this property, and how is that? Because we like the idea of like, okay, I can multiply this cash flow. If I'm cash flowing $300 a door, I get 10 doors. That's $3,000 a month. It's covering my expenses. Great. This is important. Income is important, but all these other reasons down here are really what make you successful over time and grow your net worth. So D is depreciation and tax benefits. And this is my absolute favorite thing about investing in real estate. Our goal to buy real estate is to reduce our taxable income to zero every single year through accelerated depreciation, which we've been able to do over the past few years, because taxes are the biggest expense we're always going to pay. And the less money we can give to Uncle Sam, and the more money we can actually invest and earn a return on that money year after year, that's just going to allow you to dramatically excel your goals. But just in general, the normal tax benefits you get through real estate is extraordinary. Equity is basically, in this scenario, the tenant paying the loan down for you. How cool is it that we get to go out and put 20% down on a property, but have 100% of the ownership and the benefits from tax and income purposes, where the tenant is actually paying that loan off over time for us. A is for appreciation. Regardless of short-term fluctuations, we all know that real estate goes up over time. And this is why investing in the right location is dramatically important to create success over time. And L is for leverage, which is probably the most unique and beneficial thing of investing in real estate. If you have $20,000 to invest and you invest it in stocks and you have a 5% return on investment, great. Now you have $21,000. You've earned $1,000 if you have $20,000, and you leverage it and buy a $100,000 house, and that $100,000 house goes up by the same 5% that year. Now it's worth $105,000. You've created $5,000 worth of equity. $5,000 divided by your $20,000 down payment is a 25% return on investment. So the numbers do not lie, and leverage is just a tool, right? There's good debt and bad debt, and leverage is an exceptional tool to be able to grow your portfolio over time. So I know you're all tired of hearing me probably ramble on, but I am passionate and excited about rental real estate. Obviously, our business is turnkey investing, but we're just excited to invest in the right locations year after year. And it has allowed my family to create a lifestyle that we would have never been otherwise able to, even in a professional career path, as doctors. So let's go ahead and turn it over. I'm going to stop screen sharing and go through Q&A. Here's our contact info, but we want to redirect you to Military Turnkey. David has coined the term military turnkey specifically for your group, for anyone that wants to reach out to Rent Retirement to, connect with us, to learn about turnkey investing, to learn about some of the best locations to invest in the country, or see some of the deals I talked about. Please visit www.militaryturnkey.com. And we will make sure that you get a preferential treatment to connect with our investment strategist to go through your goals. So thank you, David, for throwing that in there. And I'm just going to go through some questions here. So Michael Holmes, can we pay your company out of the cash flow payment fees for R2R? So I think I kind of covered this, but just to clarify, we do not charge you anything. We don't charge investors anything, right? Like if you think of a house flipper, when they're selling their house, or a builder, when they sell the house, they get, their profit is built into the build cost of that house. That's exactly how our company operates. We do not charge investors anything. So Michael, basically you do not need to pay Rent Retirement anything. The cash flow is all yours. When you're buying turnkey investment properties, you are 100% the owner of the property. This isn't like a syndication or like a crowdfunding or profit sharing model. You are 100% owner of the property. David, do we have any other questions from the Facebook side? Because I am unable to see the Facebook side. Or if you have, David, if you have some questions too, I mean, feel free to jump back in here.
Yeah, I am trying to catch up. I see some shares in the Facebook side, and I'm trying to see the other locations to see if there are any. I don't see any comments directly to the initial share on Facebook. I see a lot of viewers. So if you're on Facebook, just comment there and we can answer your question. But we just got a new Q&A right there from Steven. It says, I am currently deployed. I live near Cleveland and have 20K to invest when I get home. What would be a good first step to take upon my return? And what can I do in the meantime to prepare myself better? Oh, we got some questions coming in. I'll let you run the Q&A right there.
Okay. So Steven, thanks for joining in, man. Wherever in the world you're at, stay safe, brother. And if you, I guess, what would be the first step? Usually, I think the first thing to do is like if you're a newer investor and you haven't bought a property, local or otherwise, which maybe I'm assuming is the case for you, my recommendation is to come up with a goal outline. What's important to you? What type of investing do you want to do? If this is just simply your first house you're buying, look at the numbers. If you got 20, you can reverse engineer this, right? So if you got 20K as a down payment to put down, and you are looking for a pure investment property, that means you're going to be able to buy probably a $70,000 to $80,000 house. That is, if you're using 20% down. If you're interested in like investing in a property that you're going to house hack and own and live in part of it and rent out the other half, because I always think that's a fantastic way to start. That's how I started. Then maybe you can save that 20K to actually invest and use a VA loan to do no money down. I think David knows a thing or two about VA loans, I've heard. But that would be maybe a good start to look at a house that if you're in Cleveland or near Cleveland, and I think Cleveland's a great market, but if you want to invest there, then maybe use a VA loan and then look at applying that capital to invest in a property, understanding what your financing options are, start talking to lenders. That would be a good place to start. And then really having a criteria of what you're looking for in an investment property. Again, my team's happy to help you create a plan and go and share a lot of resources. We have an established large team in the Cleveland greater area. So happy to share resources with you, with lenders, insurance agents, local contractors, property managers, and we have a lot of inventory as well. So, feel free to reach out. Michael, follow up. Is there any way to utilize house hack with a residential VA loan? 100%. Yeah. So on a VA loan, you can buy 1 to 4 units, and a VA loan is just a type of conventional loan. David's probably chomping at the bit here to jump in because he's a VA guru. But if you're buying a residential property, 1, 2, 4 units, you certainly can use a VA loan to buy it out. The first house I bought, VA loan, no money down, duplex. But you can go up to 4 units, certainly. And that's a great way to. David, do you have anything else you want to plug on the VA? Last time we spoke, you taught me a few things on the VA loan where you can reset it, and you can have multiple VA loans at once, right? You don't have to. You can turn a VA loan into a pure investment later. You got to live in it or have the intention to live into it first. But
yeah, I can go all day on a VA loan. But yeah, you can house hack the VA loan all day with up to a 4 unit. So I think that's the short answer. But I've got tons of content on that, Michael. So happy to chat offline or help you with that for sure. Got some videos on that and stuff. What other questions you guys got? We don't want to dismiss you guys, but you gotta let's keep it alive.
Yeah, anything about this is open forum stuff. Whether my area of expertise is probably going to be out of state investing in general, but I have a wide experience range in commercial assets, in different types of financing options, running active real estate businesses, investing in across different locations, the tax benefits of real estate. I kind of covered a lot of really just quick high level stuff, which probably a lot of people missed or their eyes glazed over about running things like accelerated depreciation. If you guys have questions, that's a little bit of a higher level concept, but if you have questions on those type of things. I'm happy to answer those, but tax benefits are my favorite thing to talk about, because our investing strategy is completely evolved to focus on the tax side. Christopher Bell, I plan on buying a condo in Hawaii using a VA loan. It will not be cash flowing property. How can I minimize my risk for when I get ready to rent it out after I PCS from Hawaii? And David, it'd be good to have you chime in this as well. But I will say, if you're buying a condo, obviously you got to look at all the, condos with things like HOA and things like that. I think it's important to run the numbers to look at where you're at. Can you rent this out as a short term? I know Hawaii is becoming more and more regulated, especially places like Honolulu, for short-term rentals. But depending on where you're at, like, can you rent on a short-term basis? Is it only going to be a long-term basis? Is there ability to do like a midterm rental where you're doing, maybe like 1 to 3 month type of things, looking at the numbers to make sure you're not going to be significantly negative cash flow. But areas, if you're using VA loan and you're 100% financed on a property, but you're investing in a good location, as long as it's not going to put you at a huge risk where you're breaking the bank, just owning property in Hawaii is probably a good thing for appreciation long term. And I think it would be, maybe a good move. But again, how you mitigate your risk, I think, is knowing the numbers, really solidifying the numbers on what is the rental income, what are all of my expenses, what is the cash flow or negative cash flow going to look like, what anticipated appreciation am I probably going to receive year after year, and does this make financial sense? And can I support a negative cash flowing property? David, do you have anything else you want to add into that?
Yeah, I mean, the biggest thing with that is just asking, whenever you got to run those calculations, and I have an article that kind of goes way deeper into this, but asking, like, if you're going to be break even or lower, you need to be real clear about whether that's a house that, like, do you plan on living there again? Do you want to own more properties there? Do you have equity? Like, if you have equity and you don't plan on living there again, you don't want to own there long term, you don't plan on buying other rentals there, then I would take the equity and run. But if you plan on buying more there, plan on owning more rentals there, plan on living there again, or like there's a lot of different variables that play into that for me when I'm deciding whether to keep a house or rent it. Return on equity, there's so many different things that kind of play into that. And the real answer boils down to, it depends on your strategy, where you are in life, and your ultimate goals.
Yeah, and if you're not buying a house in Hawaii, what else are you doing? What else are you doing with your capital? In certain locations, Hawaii is certainly one of these. It's probably an area that you would be safe buying, just buying it however you can, just owning and controlling real estate in Hawaii, because it's likely, regardless of short-term fluctuations, it's likely not getting significantly cheaper over time. And so if you're going to be there for 3 or 4 years, and you can afford the mortgage payment on that property, and then maybe it's just an exit to sell after you leave, but you've built up a good amount of appreciation in the time that you've been there, and you don't have to pay taxes on it because you've lived there as a primary residence. That could be a very, advantageous thing for you to do. You don't want to, that's a little bit of speculation, but in all investing has a level of speculation. But simply owning in like quality locations like Hawaii are probably a good thing to do if you can afford it. Ian, I'm glad that you brought up this question. I'll read it for those of you who can't see it, because this is a huge question we get all the time. And there's a lot of confusion and misconception around the DTI requirement. So Ian says, for those who may have enough capital to fund 2 or 3 down payments at the same time, does your lender team work with the investor to overcome potential DTI, debt to income issue of bringing on 2 or 3 mortgages at the same time, or would you recommend spacing out by 6 or more months in between purchases? This is something a lot of lenders give inaccurate information to people on, but these we're mainly talking about Fannie Mae, Freddie Mac loans, which Ian is actually asking about the debt to income, the DTI requirement, which basically means, like, as you take on more debt, you won't be able to qualify for loans because your debt is increasing. And usually the lender, at least the lenders we work with, want to see about a 45% debt to income. So if you earn $4,000 a month, your expenses should be below, your debt payment should be below $2,000 fall within that 45% range. The reality is with the types of properties we are investing in the locations, these are positively cash flowing properties based on the numbers. So the lenders can actually use the income on the property, even if it's not rented, they can use a projected income to offset the debt on the property. So it should be a wash on the debt to income. It should not negatively impact, at least again, with all the properties we're focusing on, it should not negatively impact your debt or your DTI on a property. So if you have enough down payment to buy 10 properties, then you should be able to buy 10 properties at once. And most of these people, and most investors we see, ourselves included, they're usually buying in tranches, they're buying groups, because it's a pain in the ass to go through the lending, the pre-approval, the lending process, the due diligence process. It's kind of like, for economies of scale, it's better just like, okay, well, I'm going to invest in say Ohio or Alabama, and I have enough money to buy 2 or 3 of them. Like, let me choose 2 or 3 properties and go through this all at once for time purposes, and then take a mental and emotional break, and then save up some more capital and come back and do it in another tranche. But the lender certainly can offset the debt with the income or even projected income on properties. We see that with new construction. And then, so it's a wash, does not negatively impact your DTI. And then over time, it actually positively impacts your debt to income as you get to report the income on your taxes. Hopefully that made sense. Great question. Thank you for asking. Michael Holmes has, okay. Let me read this out loud. Okay, cool. Yeah, I'd love to get coffee with you. It sounds like you're out in my neck of the woods. So yeah, certainly you connect with me. I don't manage the social media stuff, but I will have my team connect with you. Perfect. What else, guys? Any loan, like I said, any lending, debt questions, market questions? I mean, our entire business is determining where the best markets are to invest. What locations do we want to be focused on? You know, how do we determine the market metrics? You know, how do we find the right property managers, the right contractors in these locations? Sometimes it takes going through 20 bad ones to find a good one. That's very expensive and frustrating. If you guys have market questions or kind of where we're at with a market cycle, that's something we usually always want to touch on, is like, where are we in the market cycle? Because a lot of the areas that we're investing in really have not seen a huge slowdown in the real estate. You know, as far as, yes, there's higher interest rates, but this is an expected thing. But really, there's still many markets where there's a huge undersupply of housing and a huge demand. So Florida is a perfect example of that. And those are the areas we want to invest in. But any other questions here? David, do you have any more on your end from the Facebook side?
It would help if I was unmuted. No, the Facebook side seems to not be very commenty this evening. But
well, did you have any questions, David? Any thoughts that came to your mind as we kind of ran through quickly on a lot of stuff about investing out of state, turnkey? Have you ever bought a turnkey? What are some markets that you like? I mean, what's your thoughts about how something like this may help people either get started or scale or diversify?
Yeah, I mean, I think that this is huge for, like, you know, the well, hang on. Click this button so I can, hey, I think this is big for, you know, people who aren't able to devote the time, right? Or they aren't in the market that they're investing in, and they don't have the ability or time to build a team. You know, I mean, there's obviously other situations where turnkey makes sense too, but I think it's especially critical in that situation where it's like, well, I want to invest, but, and a lot of people just stop there and they're like, well, I'm overseas, I can't invest, or I don't have a team and I don't want to invest where I am currently stationed. Okay, well, here's a solution to both of those problems. Ta-da! And so I think that's huge. As far as markets, I mean, you guys are in Kansas City and Little Rock for sure. Well, I love both of those places. I grew up in Little Rock and I invest 2 hours south of Kansas City in a very similar market, and live in. So, you know, I love those. I love your new builds, what you guys are doing in Florida. The thing that I really love about what you guys do is when you renovate, and I think you mentioned this in your presentation, but the fact that you guys have a rule about if something is, was it 10 years or older, as far as all the actual like big components of a house, you guys replace it. You know, a lot of these turnkey guys, not a lot, but plenty of these turnkey companies will just like slap paint through a house and be like, it looks good. And, you know, the HVAC might be 20 years old, but it's still running. So they're like, it's turnkey. And, you know, I love the fact that you guys are like, no, the water heater was 11, you know, it was at its life expectancy. Like we replaced it, even though it was completely functional. And to me, that is much more valuable for an investor, because it shows that they're getting a product that will actually last for a while before it needs to have a massive capital injection, in theory.
Yeah.
I mean, obviously there's always what ifs, but.
And I think, you know, maybe, and thank you for that, but let's talk about when not to invest in turnkey, or things to be conscious of, right? Because we're certainly not the only turnkey company out there. We do have a great public reputation that I'm very proud to stand by, because, you know, when things don't always go according to plan, which in real estate, they have a tendency not to sometimes, you know, it's always about, I think in my opinion, or, you know, when you're working with a company, and this goes with any business model or any real estate transaction, it's like, yeah, when things are going well and properties are cash flowing and tenants are paying rent, like that's not really a true test of a business, I think. And this could, like property managers especially, but a true test would be like when there's issues, how are those dealt with, and, you know, what kind of support do you have? And so certainly it's important to, for us, with our clients, that when we do have issues, like, let's talk about it. Now, some of those may be, sure, someone on our team dropping the ball. It could be nothing related to us. It could be market. It could be tenant related. However, whatever the case is, we want to be involved to help you solve the problem. Because ultimately, I mean, one, we actually care. And, you know, I think that's, you know, actually a rare thing I've come to find out sometimes in real estate and business, but ultimately it makes more financial sense for us to step in and assist people with those issues, instead of, you know, to have them come back, right? We want those people to come back. But ultimately, when things don't go according to plan, that's really the true test. And I think really when you're looking at turnkey, this is a long-term play, right? These are not properties you flip. Now, granted, there's some cool stuff you can do with new construction, where it kind of expedites that process, but these are long-term buy and hold real estate, which again, in the right location is really, you know, the goal to allow you to build a diversified portfolio. But I would say when not to buy turnkey, one of the biggest, I guess, questions or comments that we get in terms of, you know, well, or things we hear. And again, turnkey is a huge broad word across that. There's a lot of people in that space. But one common, I guess, counter argument would say there's no equity in the property, right? Like the turnkey provider is making all the money doing the flip and the rehab. And so why would you invest in something when it's at, you know, market value? And I would say that is true in a lot of cases. Again, these are not flips, right? You're not coming into, you're not doing but you're also not having to take the time and the risk and money to do the rehab on it. And like we showcased, there are some scenarios where you can buy below market value and come into immediate equity. But most sellers, turnkey or otherwise, you guys, would be are going to want to sell at market value. Why would they not, right? Unless they are in a distressed situation. So, but again, you gotta analyze this from a long-term buy and hold standpoint to say, does the cash flow make sense long-term? Does this investment meet my goals and criteria long-term? And is this an area that I want to invest in? And if it does, then it can be a win-win for everyone. It makes sense from a long-term, you know, diversification investment standpoint. But when you go through, and I would say again, when you're buying property, the other thing to look at is what David really spent some time on, is the quality of the rehab and the quality of the property. And I would actually extrapolate turnkey out of the equation and apply this to any property you're buying at all. Whether it's locally or out of state, you have to go through normal due diligence, right? You've got to realize, because you should never rely 100% on what the seller is telling you. And you should always protect yourself by having third-party due diligence. Your lender is going to require a third-party appraisal. So that's important to make sure the property is priced appropriately. Make sure you're getting free and clear title, working with a local title company or closing attorney, depending on your location, and certainly get an inspection report and make sure the inspector looks at all the things that are, important for safety items or will be big ticket items. Every single inspection report you get will always come back with a myriad of different and a long list of little repair items. Most of those should probably be just little punch list items. It'll be pretty easy, but you certainly want to go through an inspection report that is, going to point out the things, and then you go back to the seller and you either negotiate price or you have them do those things. At least with Turnkey, you pretty much, at least with our company, either you have the seller is more willing to do those things, right? Like if the roof has an issue, it's going to be fixed versus the seller saying, no, take it or leave it. Would you generally agree with that on the due diligence side, David, or?
Yeah, I do. And unless you've got a super desire to answer this next one, I actually like this next question.
Okay, from Michael Holmes here.
Yeah.
So I've heard you say set aside 5% plus for CapEx in your numbers. Does your strategy include that, or am I overestimate using your attention with remodels? So I want to separate out two things: capital expenditures and routine maintenance, because those are two things that we extrapolate in our numbers on. And when you're running your numbers on these, you got to know what, and again, this goes to any property that you purchase and evaluate. You really need to understand, like, why am I inputting these numbers that I am? Everyone wants to be conservative and say, well, if I have a 10% maintenance and vacancy and it's still cash flows, well, great. But you can also make a lot of good deals look bad because you're putting in inappropriate numbers. So you need to have justification, and holding period is a big determination in that. How long you're going to hold that property. If you're buying a property that is a brand new build, you should not be running CapEx on that unless you're going to be holding it for more than 10 years, in my opinion. If you have a builder warranty, and if you actually have, you're in a good insurance in place for natural disasters, then, you probably would be fine not putting in capital expenditures in your budget for 5 to 10 years. And maintenance will probably be a lower percentage, but that doesn't mean you can run your numbers for like that forever, right? Once you get past that 10-year mark, you surely need to start including capital expenditures. If you're buying a house that wasn't rehabbed, that's CapEx will vary widely. You can never have a standard CapEx. You got to look at your inspection report, and then you need to reverse engineer your numbers, because if you're buying a house that isn't rehabbed and you have to actually put some work into it, you may have some high CapEx expenses. Generally speaking, though, and this goes back to, it all depends on the property, right? You need to understand the property. This is why you can't really use rules of thumb sometimes. But with a turnkey property, I would anticipate 5% is more than enough for capital expenditures, because those items, if they're more than 3 years old or they don't have 10 years of life remaining in them, they will automatically be replaced. And so you really shouldn't have CapEx, but you will have routine maintenance on the property year after year. I mean, that's just part of housing a tenant. But capital expenditures, for those first five years, you probably won't have much at all. And our average holding time that we see people hold properties is 4 to 6 years, because they built equity through appreciation and debt reduction, and they've saved up the cash flow. They usually sell the property in 1031. And so usually most people are selling before they have any large ticket items. So
I like that answer. And just to clarify, in case that got misheard, he meant if you only plan on holding for 10 years. If you plan on holding forever, don't skip on the budgeting for CapEx in the first 10 years. Should at least start the budgeting process, so you're setting it aside.
Yeah, but, 5% CapEx on a $300,000 house, right? That's over, a roof is, call it $10K, right? So what is that?
So that was going to be my point on this, right? Is I generally, when I first started, right, I was like, yeah, 7%. I budget 7%, and that was my numbers, and I told people that for a while. But I'm also in a market where I'm buying $100,000 house. And so for me, like 7%, yeah, cool, whatever. That is not unreasonable, because my, that's like $70 a month or whatever, on like the high end. But going by percentage is great sometimes. But what I realized when I got stationed in Hawaii or San Diego, and I'm telling people like, yeah, man, 5%, 7%, like, a roof does not grow in expense at the same rate as the property value. So a roof, a 3-bed, 2-bath that costs $100,000 here in Springfield might cost $1 million in San Diego. Well, that $10,000 roof here does not cost $100,000 in San Diego. It might cost 45, 40, 35, so my 5% CapEx budget could probably be 2.5, 3% in San Diego and be the exact same, because the house costs twice as much, but or 5 times or 10 times as much, and the actual CapEx might only cost twice as much. And so you got to just, it's going to vary market to market, right? So you got to know your area. And so I'm actually in the process of tweaking this, but I have a CapEx like calculator. And I would just, once I'm done building that and launching the blog post on it, I'll post it for everybody. But the best, like most accurate way to do this is to literally just average out like the cost of the major line items, and then just know your properties enough to be able to be like, yeah, I need 10 square for a roof and 1 HVAC and whatever. You do it one time on your property, and then it tells you this is how much you should budget per year, depending on how long you plan on holding the house and whatever. Like, that's the most accurate way to do it. Now, does anyone really do that? No, but it gives you an idea, because percentage wise, you could probably get by with 1 or 2% on $1 million home, and you're probably going to need to be closer to like 7% on a $50,000 home. So
one thing I've kind of changed my philosophy on, or kind of reevaluated, is just like reserves in general. And so, to be quite honest, like I don't even, when I'm looking at a analysis for property, I don't even actually run CapEx. This is a reserve I need on this property at this point in time. And I know, because like, even if shit hits a fan, it's going to be like, that's going to cover it. Right. And then, and we've also learned, like, as we grow our portfolio, we increase our reserve amount, but not like incrementally per property, because it's very unlikely that all those properties are going to have a really large expense or vacancy all at once. And so, for example, maybe with a single family house in the Midwest, we might have, like, call it at any given point in time, we'll want, say, call it a $8,000 or $10,000 reserve for that property. But when we when we get to property 10, it probably doesn't make sense to have $100,000 reserve. Maybe we could bump that down to $50,000, because likely, and I'm just throwing these numbers out there arbitrarily as an example for right now, but maybe there's, if there's going to be a larger repair on that item, like, that capital is enough to make that repair and still have a buffer room. So that's kind of the way that we've started to evaluate our portfolio, is just reserve in general. And I also think that a lot of people come into investing, and this could be certainly appropriate for some people, but think that they want to hold the property long term. And like, hey, I'm gonna buy this house, have 30 years, own it for 30 years, it'll be paid off free and clear, fantastic. And now the cash flow is much higher because I don't have a loan. And while that's quite possible, usually there's kind of this optimal period of time of owning a property where, before you start to experience a lot of these CapEx that you have, and the property is performing well, you have the house is appreciated, and then the loan's been paid down. Maybe it makes sense to 1031, and sell that property. So there's always like this optimal exit time. And we found more often than not, people are not keeping the houses forever, just because maybe there's a new market and you want to be, like you said, conscious of return on equity. So, I think keeping your portfolio somewhat dynamic is important too. So I think I think Michael's question I just answered, at least if I'm reading that correctly. So as your portfolio grows, do you have a big pool for all your properties, or do you keep separate reserve pools? So I think that's what I was just referring to. And I just keep a reserve account. It doesn't need to be necessarily broken up in between properties. I just know, like, hey, there's this reserve account where, and I tend to be a little bit more risk averse over time as time has went on, but I have okay, good. I have the list of, or I have a pool of reserve. And as I grow my portfolio, that does increase, but it incrementally increases less and less.
Right on. Well, much as I'd love to stay on and answer questions all day with you, I do have to pick a kid up from baseball here soon, so probably do need to wrap up. Unless there are any parting thoughts from you. I mean, it's been good for me. Once again, for anyone who's listening and can't see it in the chat, the link for more information and to jump on a call with Zach and his team is militaryturnkey.com. Should be pretty easy to remember. I'm actually really surprised that that domain was not taken.
Yeah, good job.
The moment that I went on there and was like, I wonder if this is open, and I bought it, I was like, Paul, email Zach and rub it in his face that I own that.
That is that's awesome. Super easy to remember, super relevant. I think this has been a pleasure, David. Obviously, I have a military background, and I love what you guys are doing with just all the education and content you're doing out there. Real estate is just for us. Yes, we're like, our business model is turnkey. But in general, like I said, we're very passionate about real estate. We have all sorts of lender resources, and your community shares. I mean, great thing about Military to Millionaire is, like, you guys have a tens of thousands of people collaborating and sharing, resources and stuff. But if we also have plenty of resources as well, specific to the locations we work in, we're very passionate about real estate. It is, like I said, a lifelong journey. It's not easy. It takes time. This is not some get rich quick scheme over time. We've all seen, different stuff of different ways you can participate in real estate and the gurus out there. But look, if you just invest strategically and keep doing it again and again and again and over, like, you get this exponential growth. It's hard to see that in the beginning years, but it is cool when you get to a point where your properties are buying properties, or you go through your first 1031 exchange and you trade one property to turn it into three, and you triple or quadruple the cash flow without having to put more capital down. Right. And that's really, I think, where the lifestyle aspect gets created. Real estate is kind of this, we talk about different levels of financial independence, where you cover your expenses, maybe the first one, and then you can cover your active income, and then you can increase your lifestyle and create generational wealth. And it is possible for every single person to do if they just have a strategy and continue to invest over time. And that's what we're here to help people with. But certainly, if people are interested in turnkey as a way to just scale and diversify, easy way to get started, you want to look at some of the, maybe the new construction stuff, or if you found something interesting we talked about, reach out. We'd be happy to speak with you and, help you along the way.
I love it. Sounds great, brother. Well, I appreciate it very much, and I hope you have a good evening, and thank you very much for joining us today.
Hey, pleasure's all mine. Thanks so much, David.
Absolutely. Everybody have a great evening.